Hello guys, in this video we are going to talk about price per earnings ratio or commonly known as PE ratio in the stock market. This is one of the important parameters to be watched while buying a share. So let's see what it is deeply so that you understand it really well. So let's break it down. PE is market price per share divided by earnings per share. So first, what is market price per share? It is simply the last traded price of the share. That is, at what price the share is currently bought and sold. Then how to calculate earnings per share? It is a simple formula. Earnings per share is profit after taxation divided by total number of shares. So what is the profit after taxation? It is a profit made by the company after paying its taxes. So let's assume an easy example to understand. In this case, a company XYZ Incorporated made a profit of 30 lakhs and its taxation comes around 10 lakhs rupees. So its final profit after taxation would be 30 minus 10, 20 lakhs. Then for calculation purpose, we assume the company has 1 lakh shares outstanding. Now the company's earnings per share would be 20 lakhs divided by 1 lakh. That will give a value of 20. Now let's say the last traded price of the share is 400 rupees. That is sold and bought at rupees 400. Then PE ratio comes to price per share divided by earnings per share. That is, price per share is 400 rupees and earnings per share, that is calculated before 20. So 400 divided by 20 is 20. Now we have a PE value of 20. So what does this PE value mean to us? This means to make a earning of rupees 1 from a share, we are ready to pay 20 rupees. So how can we infer from this value? We basically can compare this value with its competitor. That means we can compare the State Bank PE with its competitor, let's say HDFC Bank, or with its industrial PE, which is comparing it with the Bank Nifty, which accounts for the best banks in India. If you want to have a clear knowledge about indexes, click above here. So back to the video. With that comparison, we can say lower PE means we can expect a high return. As in State Bank of India example, for 1 rupee return, we are ready to invest 11 rupees. Whereas higher PE means lower returns, as we need to expect 1 rupee return for every 21 rupees invested in HDFC Bank. But one important point to be remembered is if a company has a bad news around it or does not perform well, also we will have a lower PE. In order to invest, you must not only focus on PE values, you must focus on company's earning report and its product quality. And there are two different types of PE, that is trailing PE, which takes account for prices in past transactions, that is past month or past year prices. Whereas there is another case of PE, that is forward PE, which takes the estimated amount of share price and calculate the PE. So we can for sure say that trailing PE would be more accurate than forward PE, since it is calculated based on the prices in the past, whereas forward PE is calculated by the estimated prices. So always look into account of trailing PE, whereas in some cases forward PE may be useful. Finally, we will recap what we have seen today up to this. PE value is how much you are ready to invest in order to get a return of 1 rupee from it. And most importantly, before buying a stock, compare it with its competitor to get a better profit out of it. If you like this video, you would also like to know about market cap, another important parameter to be watched in the stock market. So click right here, and lastly subscribe for more videos like this and press the bell icon to get notified every single time.